Imagine wiring $10 million for a 20% stake in a company at, let's say, 9:00 a.m.
Okay.
You sign all the final paperwork, and you take a sip of your coffee, and by 9:01 a.m., the literal moment those shares officially hit your digital account, the market just completely crashes.
Oh, wow.
Yeah. Your massive strategic investment is suddenly worth like $6 million. You are down $4 million in 60 seconds. Do you, as the chief financial officer, basically have to immediately write down a massive loss on your balance sheet before you've even had a chance to, attend your first board meeting?
I mean, the panic in that finance department would would be completely suffocating.
Right.
Yeah, the CFO is just staring at the stock ticker, the phone is ringing off the hook, and the audit committee is already demanding to know what this means for the quarterly earnings report. It is, frankly, the ultimate accounting nightmare, where market volatility just instantly collides with the rigid, unforgiving rules of corporate reporting.
Well, welcome to a brand new deep dive on the Gap Advisors Ind AS Clinic podcast. We are unpacking a highly specific, very real-world dilemma today that hits right at that intersection of corporate investments and sudden stock market drops.
Exactly.
We're going to find out exactly what happens to those numbers and how standard setters actually force companies to navigate the chaos of an instant market collapse.
Because understanding the mechanics of this specific scenario really requires us to untangle several overlapping rulebooks. I mean, we have to separate the actual economic reality of the business from the psychological panic of the stock market.
Before we get into the weeds of those rulebooks, though, let's talk about why you, the person listening to this right now, why you should care.
Yeah, that's important.
Because it is incredibly easy to hear phrases like impairment testing or carrying value and just assume this is only a problem for people with CPA after their name.
Right, like it's just academic.
Exactly. But if you are a retail investor, if you were putting your hard-earned money into the shares of a listed company to save for retirement or a house, you absolutely must understand how these accounting standards work.
You really do.
The way a company reports a sudden loss in its investments completely alters its financial health. I mean, it changes their reported profit, it changes their asset value, and that in turn directly affects the value of the stock that you are holding.
Without a doubt. If you don't understand the language of accounting, you literally cannot tell the difference between a company that is fundamentally bleeding cash and a company that is just experiencing temporary paper volatility. You're basically investing blindfolded.
Yeah, and financial statements they're the only true window a retail investor has into management's actual decisions, right?
Exactly. And management teams are human. They do not want to report a massive loss if they don't absolutely have to.
Of course not.
So the accounting standards are really the only defense mechanism the public has to force management to tell the truth about bad investments. I mean, if a company uses a loophole to hide a massive loss overnight, that changes your entire investment thesis. You might hold on to a stock thinking the company is highly profitable, completely unaware that a massive crater is just sitting on their balance sheet, obscured by, complex reporting maneuvers.
To decode this language today, we need to establish our framework and the operational baseline for this scenario. We are pulling a real query, a literal panic moment, from a finance professional who needed an answer fast.
Right, so we are looking at this through the lens of the Indian accounting standards, or the Ind AS framework.
Okay.
But, and this is crucial for our international listeners who might be tuning in, it is vital to know that there is zero difference between Ind AS and IFRS for the specific topic we are breaking down today.
Oh, that's great.
Yeah, so if your entity operates under the IFRS framework anywhere in the globe, the logic, the treatment, the mathematical triggers, and the standard numbers we discuss, they mirror your reality perfectly.
That universality makes this so important. So, what is the baseline for our deep dive today?
For this specific transaction, we are operating under the assumption that the functional and presentation currency is the Indian rupee, or INR.
Got it.
Any currency other than that functional currency is treated as a foreign currency, which, brings in its own set of translation rules that we will just bypass for today's focus so we don't get bogged down.
Right, keep it clean.
Exactly. Furthermore, our reporting period follows the standard Indian financial year, which runs from the 1st of April to the 31st of March.
Okay, we also have a mandatory disclaimer that sets the boundaries for our exploration today, which we need to get out of the way.
Yes. The views expressed in this deep dive are the personal views of the author of our source material, and they are not binding on the audience. Every listener is strongly requested to seek the help of a professional expert before taking or, refraining from any action based on the views discussed herein.
Because every corporate transaction has its own weird little contractual nuances, right?
Absolutely. Tax implications, historical context, professional judgment applied to your specific facts is always, always required.
Let's talk about where this fascinating scenario actually originates. Today's deep dive is sourced directly from the issue repository on gapadvisors.com.
It's such a great resource.
It's staggering, really. This platform hosts over 4,500 highly specific issues and their detailed technical responses covering Ind AS and Indian GAAP, and anyone can register for free, submit their own tangled accounting queries, and get a detailed response delivered straight to their registered email inbox. It is an absolute lifeline, particularly for auditors who are sitting in a conference room with a combative CFO and desperately need concrete, documented rationale on how to address a highly specific application of Ind AS.
It really bridges the gap between the theoretical rulebook and the messy reality of corporate finance. And the specific issue we are dissecting today was recently featured in the 206th edition of the Gap Advisors Task Weekly newsletter.
Oh, nice.
Yeah, this newsletter is authored by C.A. Manish C. Iyer, who is the director of Gap Advisors. He publishes it directly on LinkedIn, and with over 230 editions published to date, it has really become a staple for finance professionals.
So if you're on LinkedIn, you should be reading this.
Absolutely. If you are active on LinkedIn, subscribing to this free newsletter is one of the highest return investments you can make in your own technical knowledge base.
Okay, so we have our framework. The disclaimers are clear. Let's look at the anatomy of this specific investment and what we can call the 20% threshold.
Let's do it.
Here is the fact pattern from the source query. An investor, let's just call them Apex Manufacturing, decides to buy equity shares in an investee company, which we will call Lithium Dynamics.
Good names.
Thanks. So Apex and Lithium agree on a price, and that price is pegged directly to Lithium Dynamics' current market price on the stock exchange. And crucially, Apex is acquiring exactly a 20% stake in Lithium Dynamics.
That specific number, 20%, is the structural foundation of literally everything that follows in this scenario.
Really? Just that number?
Yes. In the realm of Ind AS 28, crossing that 20% threshold is a transformative event. It is the line in the sand where the accounting framework presumes the investor Apex Manufacturing, in this case, has now obtained what they call significant influence over the investee.
Significant influence. Okay, let's spend some time on that because to a layperson, 20% sounds like a minority stake.
It does.
You own 1/5 of the company. You are outnumbered 4-1. You don't have control. You can't just walk into the CEO's office and fire them. You can't unilaterally decide to sell off a factory. So how does owning 20% suddenly grant you significant influence in a way that fundamentally alters the accounting?
It is about the power to participate, not the power to dictate. That's the key distinction.
Okay, the power to participate.
Right. Significant influence means Apex Manufacturing now has a voice in the financial and operating policy decisions of Lithium Dynamics. They do not have control, or even joint control, but their voice carries undeniable weight. In practice, a 20% stake almost universally guarantees Apex a seat on the board of directors.
Ah, okay.
So they are in the boardroom when the annual budget is approved. They are in the room when dividends are discussed. They have access to internal management reporting that a normal retail investor never, ever sees.
I used a car analogy to think about this previously, but let's expand on it because the nuance is really important here. If you, as a retail investor, buy 1% of a company, you are basically a passenger in the back seat of a bus.
I like that.
You paid your fare, you hope the bus goes to the right destination, but you have zero say in the route. If the driver hits a pothole, you feel the bump, but you can't grab the wheel.
No, you're just along for the ride.
Exactly. But when Apex buys 20%, they move from the back of the bus to the passenger seat of a car. They don't have their foot on the gas pedal, the CEO still has that, but Apex is holding the map.
Right.
They can lean over and suggest a different route. If the driver is about to make a disastrous left turn, Apex can raise a massive objection right there in the car. They are fundamentally involved in the navigation of the business.
That is a perfect way to look at it. And the accounting framework has to reflect that reality. Because Apex is in that passenger seat, Lithium Dynamics is no longer just a passive stock sitting in Apex's portfolio. It is officially categorized as an investment in associate.
Investment in associate.
Yes. And an associate is accounted for using a deeply specific mechanism called the equity method.
Explain the philosophy behind the equity method, because, I mean, if Apex bought these shares based on the stock market price, they bought them on the open market, right?
Correct.
So why not just treat them like any other stock trade? If the stock goes up, Apex records a gain. If the stock goes down, Apex records a loss. Why does this significant influence thing force us to completely abandon the daily stock ticker?
It comes down to the intention behind the capital. If you buy a 5% stake in a tech startup, you are likely doing it for capital appreciation. You just want the stock to pop so you can sell it and make a quick profit.
Right.
But when a massive entity like Apex buys 20% of Lithium Dynamics, they aren't day trading. They are making a strategic long-term alliance. Perhaps Lithium Dynamics produces a very specific battery component that Apex desperately needs for its manufacturing line.
So it's an operational move.
Exactly. Apex wants to secure their supply chain. They are integrating their economic futures together.
So measuring that investment by what random day traders are doing to the stock price on a Tuesday afternoon doesn't actually reflect the true strategic value.
It creates a completely false narrative on the balance sheet. If Apex recorded daily market fluctuations, their own reported income would just bounce wildly up and down based on market sentiment toward Lithium Dynamics, completely obscuring Apex's actual operational performance.
That would be a nightmare for investors trying to read Apex's statements.
It would be useless data. So the standard setters created the equity method to tether the accounting to the actual fundamental business performance of the associate, not the emotional swings of the stock market.
Walk me through the mechanics of the equity method step by step. Let's
Yeah.
put some hypothetical numbers to this so we can really see it.
Sure. So on day one, which is initial recognition, Apex records the investment at cost. Let's say they paid that $10 million. The carrying value on Apex's balance sheet is now $10 million. From that day forward, the daily stock price is essentially ignored for routine accounting purposes. Instead, Apex looks at Lithium Dynamics' actual income statement at the end of the year.
So they look at the real business.
Exactly. If Lithium Dynamics generates a net profit of $1 million for the year from selling batteries, Apex recognizes their 20% share of that real operational profit.
So 20% of $1 million is $200,000.
Correct. Apex increases the carrying value of their investment on their own balance sheet from $10 million to $10,200,000. And they recognize that $200,000 as income in their own statement of profit and loss.
What if Lithium pays out a dividend?
Good question. If Lithium Dynamics pays a dividend, Apex doesn't treat it as income. They treat it as a return on their investment, and they actually reduce the carrying value.
Oh, because they're taking cash out of the business.
Precisely. The equity method essentially forces Apex to mirror the fundamental operational reality of the business they are now deeply involved with.
That makes profound logical sense for a long-term partnership. You want the financial statements to report on the business, not the casino of the stock market.
Exactly.
So that is the baseline. We have our 20% stake, we're in the passenger seat, and we are ready to apply the equity method. But now we hit the trigger event, the moment where the theoretical framework violently collides with the terrifying market reality. Let's look at the timeline of the transaction.
The timeline is where all the friction is generated here. When a massive block of shares is purchased, it is rarely an instant over-the-counter swap. There is a contract date, and then there is a settlement date.
Right. Apex agrees to the $10 million price on a Monday, let's say. They sign the term sheet. But the actual transfer of shares, the moment Apex officially becomes the legal owner and the money actually changes hands, might be Thursday.
Right.
And on the exact date of transfer, the market price of Lithium Dynamics experiences a sudden, massive collapse.
The querist in our source material stated the market price went down substantially right on the exact date of the share transfer. It is just a catastrophic alignment of timing.
Put us in the shoes of the Apex CFO on that Thursday morning. I mean, they just wired $10 million, they refreshed their screen, and the market capitalization of Lithium Dynamics has plummeted. Their 20% stake, which they just paid $10 million for hours ago, is currently trading on the open market for $6 million.
The CFO is experiencing a massive adrenaline spike. The immediate instinct is self-preservation and compliance. They know they're holding an asset that the open market says is damaged goods.
Yeah, the auditors are going to be arriving in a few weeks to review the quarterly financials.
Exactly. The CFO has to figure out proactively what the rule book demands in this highly specific scenario of an instant day one collapse.
The exact question submitted to the Gap Advisors repository was this: does this sudden substantial depreciation in the quoted share price amount to a sufficient indicator to recognize an impairment in the carrying value of the investment?
Basically, do we have to officially declare that this investment is permanently damaged and write down its value, taking a massive hit to our profit right out of the gate?
Right. And the querist was desperate for a specific anchor in the standards. They didn't just ask the conceptual question. They tried to identify the rulebook. They asked, if further impairment is required, please specify the paragraph of Ind AS 39 or 109 that dictates this.
They were looking for a life raft.
Now, I want to step in here and forcefully advocate for the querist for a second because their logic makes total intuitive sense. They are asking about Ind AS 109. The title of Ind AS 109 is literally financial instruments.
It is.
Equity shares are the absolute definition of a financial instrument. They are traded on a financial exchange. So why on earth wouldn't a CFO use the accounting standard specifically designed, named, and created for financial instruments to figure out if they lost money on their shares? It feels like the accounting board is intentionally hiding the ball by putting the rules somewhere else. It feels deceptive, honestly.
I understand that frustration completely. It really feels like walking into a library, looking for a book on baking bread and being told it's not in the culinary section, it's hidden in the chemistry aisle.
Yes.
But this is a perfect illustration of how accounting standards operate based on the nature of the relationship, not just the physical form of the asset. The response from Gap Advisors provides a swift, definitive correction to the querist. It states clearly that Ind AS 109 is not applicable to an investment in an equity instrument of an associate.
The doors just slam shut. So how does Ind AS 109 justify kicking this massive financial instrument out of its jurisdiction?
We have to look at paragraph 2.1a of Ind AS 109, which is the scope paragraph. The scope paragraph acts like a strict bouncer at the door of the standard. It defines exactly what is allowed inside, and more importantly, it explicitly lists what is barred from entry.
Let me read the exact language from the source document to see how this bouncer operates.
Go for it.
Paragraph 2.1a of Ind AS 109 states that it applies to all financial instruments except those interests in subsidiaries, associates, and joint ventures that are accounted for in accordance with Ind AS 110, consolidated financial statements, Ind AS 27, separate financial statements, or Ind AS 28, investments in associates and joint ventures.
The standard is actively pointing you away from itself. It is acknowledging the reality. It basically tells the accountant, yes, I know these shares look like a standard financial instrument, but because you hit that 20% threshold, because you established significant influence, your relationship with this asset has fundamentally changed.
You're not just holding a stock certificate anymore.
Exactly. You are not holding a tradable instrument. You are holding a piece of an operating business. Therefore, you are outside my jurisdiction. Go to Ind AS 28.
Okay, the bouncer analogy works. The bouncer checks our 20% VIP pass and tells us we belong in a different club entirely. But I do see a tiny caveat in the text I just read. The quote continues. However, in some cases, Ind AS 110, Ind AS 27, or Ind AS 28 require or permit an entity to account for an interest in a subsidiary, associate, or joint venture in accordance with some or all of the requirements of this standard. And then it mentions derivatives. What is that exception about? Did the bouncer leave the back door open?
It is a very narrow, highly specialized exception. Corporate structures can be incredibly complex. Let's say Apex Manufacturing bought the 20% stake, but as part of the deal, they also bought a derivative, perhaps a complex call option, that gives them the right to buy another 10% of Lithium Dynamics at a fixed price in 2 years.
Okay.
That specific call option, that derivative, does not represent current significant influence or current ownership. It is just a speculative financial bet. Therefore, that specific derivative contract might fall back under the purview of Ind AS 109.
Ah, I see.
But the core 20% equity stake, the actual associate investment itself, that remains strictly locked inside Ind AS 28.
So Ind AS 109 is firmly out for the core problem. But the querist also asked about another standard, Ind AS 39. And this is where the history of accounting standard setting becomes really important context.
Oh, absolutely. The mention of Ind AS 39 by the querist is fascinating because it is essentially a phantom standard in this context. The response from Gap advisors drops a definitive fact here. Ind AS 39 has not even been notified in the company's Indian Accounting Standards Rules 2015.
Wait, so the querist is asking for guidance from a rulebook that doesn't legally exist for this application.
Exactly.
It's like trying to argue a foul in a basketball game using the rulebook for ice hockey. Why would a finance professional even bring it up?
To understand why, we really have to look back at the global evolution of accounting, particularly around the 2008 global financial crisis.
Okay, let's go back.
Before 2008, the global standard for financial instruments under IFRS was IAS 39. And IAS 39 operated on what we call an incurred loss model.
Incurred loss.
Yeah. You essentially couldn't record a loss on a financial instrument until the loss had already definitively happened. The trigger had to be pulled. During the 2008 crisis, banks were holding massive portfolios of toxic mortgages, but because the actual defaults hadn't strictly occurred yet under the rigid rules of IAS 39, they couldn't write them down.
So everyone knew they were worthless, but the accounting rules said they were fine.
Precisely. It was deemed too little, too late. The financial statements didn't reflect the impending doom that literally everyone knew was coming. The accounting rules actually prevented companies from sounding the alarm.
That's wild.
It was a catastrophic flaw. So standard setters undertook a massive project to replace IAS 39 with a new standard, IFRS 9, which moved to an expected credit loss model.
So looking forward instead of backward.
Exactly. It forced companies to look forward and record losses they reasonably expected to happen, rather than waiting for the cliff edge. Now, when India transitioned to its new Ind AS framework, they decided to leapfrog the outdated rules. They largely skipped over the old IAS 39 entirely and went straight to adopting the equivalent of the new IFRS 9, which became Ind AS 109 in India.
So the querist, perhaps relying on, old global training or outdated textbooks, referenced IAS 39, not realizing that in the Indian context, that standard was completely bypassed for this topic.
Exactly. They were lost in the wrong library looking for an outdated book. It really highlights how chaotic navigating these frameworks can be under pressure. The CFO is looking for a lifeline, and they're grasping at titles of standards that seem relevant but are structurally completely wrong.
We have successfully debunked the red herrings. Ind AS 109 and the phantom Ind AS 39 are dismissed. We are redirected back to the true north, Ind AS 28. This is the standard that governs our 20% passenger seat investment. Where exactly in the specific rulebook do we look when the market collapses on day one?
We navigate straight to paragraph 40 of Ind AS 28. This paragraph is the critical bridge. It is the mechanism that transitions a company from routine, peaceful accounting into emergency impairment protocols.
Let's analyze this specific text of paragraph 40. It says, after application of the equity method, including recognizing the associates or joint ventures losses, in accordance with paragraph 38, the entity applies paragraph 41A to 41C to determine whether there is any objective evidence that its net investment in the associate or joint venture is impaired.
Notice the chronological mandate in that sentence. It says, after application of the equity method. The standard is demanding discipline. Even if the market crashes on Thursday, the standard says, calm down, do your fundamental job first.
So business as usual first.
Right. If Lithium Dynamics lost money in their actual battery manufacturing operations that month, Apex must record their 20% share of that operational loss first.
You do the routine math before you hit the panic button. You establish the baseline carrying value based on the business reality before you evaluate the market panic.
Correct. But once that routine operational math is done, paragraph 40 explicitly directs you to paragraphs 41A through 41C. These paragraphs are the accounting equivalent of an early warning radar system. They list highly specific scenarios that constitute objective evidence that something is fundamentally structurally broken with your investment.
We're looking for the trigger that sets the alarm off. And the response from Gap advisors points us directly to the smoking gun. It is located in paragraph 41C. Let's look at the critical sentence regarding equity instruments. A significant or prolonged decline in the fair value of an investment in an equity instrument below its cost is also an objective evidence of impairment.
This is where the language requires deep, critical parsing. A significant or prolonged decline. That word "or" is doing immense structural work. It creates two distinct, entirely independent triggers. You do not need both. You only need one to set the alarm ringing.
Let's dissect them. Start with prolonged.
Prolong is a trigger based entirely on time. Let's say Apex bought the shares for $10 million and the market drops so they are worth $9 million, a 10% drop.
Okay.
In the grand scheme of the stock market, a 10% fluctuation is routine noise. It isn't a catastrophe. But If that price stays at 9 million for 6 months, 9 months, a year, the sheer duration of that depression becomes objective evidence. The market has had ample time to correct itself, to realize the value, and it has refused. The market has permanently repriced the asset. Even if the drop isn't violent, the prolonged reality indicates an impairment exists.
But our querist didn't have the luxury of time. They stated the market price went down substantially, right on the exact date of the share transfer. Time is zero. It happened instantly, so prolonged is off the table entirely. We have to come to the other side of the or, the word significant.
Significant is a trigger based entirely on magnitude. If the drop is deep enough, violent enough, time is irrelevant. The sheer size of the collapse is immediate objective evidence that the underlying value you just paid for is fundamentally impaired.
Now, here is where it gets incredibly subjective. The standard doesn't give a mathematical threshold, does it? It doesn't say a 25% drop is significant. It doesn't provide a safe harbor. It relies entirely on professional judgment.
And that is a deliberate choice by the standard setters. If the standard said a 20% drop is significant, companies would engineer scenarios where a stock drops 19.9% and argue they don't have to test for impairment.
Oh, of course they would.
Bright line rules invite manipulation. By using a qualitative word like significant, the standard forces the CFO and the auditor to look at the specific economic context. However, the querist specifically stated the price went down substantially. While substantial is a qualitative word, in any reasonable auditor's professional judgment, a substantial immediate drop upon purchase clearly meets the threshold of being significant.
The fair value, the market price, has significantly declined below the cost. The condition is perfectly met. The radar system has detected an incoming threat. The alarm bells are ringing throughout Apex Manufacturing's finance department. We have definitive, objective evidence of impairment under Ind AS 28.
We have identified the symptom.
Which naturally brings us to the ultimate million-dollar question. We found the evidence. We know the alarm is ringing. Does the Apex CFO just look at the stock ticker, calculate the $4 million difference between what they paid at 9:00 a.m. and the current price at 9:01 a.m., and immediately record a $4 million loss on the balance sheet? Do they just take the hit right then and there? Is the process over?
This is where almost every layperson and quite a few junior accountants make a massive conceptual error. The answer is a definitive, resounding no. Finding the objective evidence of impairment, hearing the alarm ring, is not the end of the math. Paragraph 41C simply tells you that a problem exists. It does not dictate how much the impairment actually is.
Wait, I need to push back on this again. This feels like accounting semantics. The market price literally just told us exactly what the asset is worth right now. The open market says it is worth $6 million. Why can't we just use the number the market is screaming at us? Why overcomplicate it?
Because if we just use the market price, we are violating the entire foundational philosophy of why we are using Ind AS 28 and the equity method in the first place. Remember our discussion about strategic value.
Right, the supply chain integration.
Exactly. Apex isn't holding this to flip it. They are holding it to integrate lithium dynamics battery technology into their supply chain over the next decade. The stock market is an aggregate of human emotion, algorithmic trading, and short-term panic. It is highly prone to irrational overreaction. Perhaps a macroeconomic news event caused the entire tech sector to drop 20% that morning. That doesn't mean Lithium Dynamics Battery Factory suddenly produces 20% fewer batteries.
So the business itself might be perfectly fine.
Exactly. Accounting needs to reflect the fundamental, long-term, recoverable economic value of the business, not the daily panic of day traders.
That makes profound sense. If the market is acting irrationally, the accounting framework provides a buffer so you don't destroy your balance sheet based on a temporary panic.
Yeah.
So if we don't just subtract the stock ticker difference, what does Ind AS 28 actually instruct the CFO to do next?
Ind AS 28 does something incredibly elegant here. It essentially says, my job is done. I am the primary care doctor. I ran the routine blood work. I noticed a severe anomaly, the significant stock drop, and I am officially diagnosing that you have objective evidence of a problem. But I don't perform surgery. I am handing you off to the specialist.
The specialist.
Yes. Because the condition in paragraph 41C is met, the company is mandated to comprehensively test the entire investment for impairment. And that rigorous testing must be done in accordance with an entirely different standard, an AS 36 impairment of assets.
That analogy perfectly illuminates the architecture of the standards. In AS 28 is the general practitioner who flags the symptom. And AS36 is the specialist who conducts the deep, invasive scans to determine if the organ is actually failing or just bruised. Let's step into the specialist's office. How does Ind AS36 actually perform this surgery? What is the mathematical mechanism?
Under Ind AS 36, the core directive is to compare the carrying amount of your investment, which is the $10 million recorded on your books, against its recoverable amount. If the carrying amount is higher than the recoverable amount, you must write it down to the recoverable amount. The difference is your impairment loss.
The million-dollar question is, how do you determine the recoverable amount if you are ignoring the stock ticker?
And AS 36 defines the recoverable amount as the higher of two distinct calculations: fair value less costs of disposal, ND value in use.
Let's break those down. Fair value less costs of disposal seems straightforward.
It is. That is essentially the market approach. If Apex had to liquidate this 20% stake today, what could they get for it? In our scenario, the market crashed. The fair value might literally be that $6 million we see on the ticker, minus whatever broker fees it would cost to sell the massive block of shares. Let's call it $5.9 million.
So if we stop there, Apex has a massive impairment, but you said it's the higher of the two calculations. What is the second calculation, value in use? Because this sounds like where the real magic or manipulation happens.
Oh, it absolutely is. Value in use is the accounting equivalent of an MRI. It is a deeply complex, forward-looking financial model. It requires the entity to estimate the future cash flows they expect to derive from the investment.
So they have to predict the future.
Yes. Apex has to look at lithium dynamics and project how many batteries will they sell next year, in 3 years, in 5 years. What will the profit margins be? What dividends will they pay out to us? Apex builds a multi-year projection of all the cash that this 20% stake will generate.
But money in 5 years isn't worth the same as money today because of inflation and opportunity costs.
Exactly. That is why the model must apply a discount rate. This is called a discounted cash flow, or DCF, model. Apex must determine a weighted average cost of capital, or WACC, which reflects the risk of the investment. They discount all those projected future cash flows back to a present-day value. They also have to calculate a terminal value, which is essentially an estimate of what the asset will be worth at the end of the projection period, assuming a steady state of growth.
This sounds incredibly subjective. The CFO of Apex does not want to record a $4 million loss on day one. It makes them look incompetent for agreeing to the purchase price. So they have a massive incentive to build a highly optimistic value in use model. They might project that battery sales are going to grow at 20% a year instead of 5%. They might use a lower discount rate to make the future cash look more valuable today.
You have just described the fundamental tension in every audit room globally. The CFO is heavily incentivized to protect the balance sheet. They will present a DCF model to the auditors that shows the value in use is actually $10.5 million. They will argue, look, the market is panicking right now, the fair value is $6 million, but our internal models show the long-term cash flow is worth $10.5 million. Because $10.5 is higher than our carrying amount of 10, no impairment is required.
And what does the auditor do? Because the auditor is the line of defense for the retail investor we talked about earlier.
The auditor's job is to ruthlessly attack the assumptions in that model. They would challenge the growth rate. They will ask, why are you projecting 20% growth when historical industry averages are 6%? They will challenge the discount rate. They will demand to see the actual contracts supporting the projected sales. It is a grueling, highly technical negotiation over the future.
If we bring this back to the retail investor sitting at home reading the annual report, how do they know this battle even took place?
They look at the footnotes. If a company has a massive investment where the market price has collapsed, but they haven't recorded an impairment, Ind AS 36 forces them to disclose the key assumptions they used in their value and use calculation. A savvy retail investor can read those footnotes. If management says, we avoided an impairment by assuming a 30% annual growth rate in a recessionary environment, the investor knows management is essentially using accounting duct tape to hold the balance sheet together. The problem hasn't gone away, it's just been deferred.
That is mind-blowing. So the sequence of events is this. The market crash triggers the alarm under Ind AS 28. The alarm forces the CFO to build the complex DCF model under Ind AS 36. The auditor stress tests the model, and if After all that rigorous testing, the fundamental business really is sound. The company is safe from writing down a massive loss just because the stock market had a bad Tuesday. The framework acts as a shock absorber.
Precisely. Or conversely, if the auditor rips the model apart and proves that the fundamental value really is gone, perhaps the market crashed because a competitor just patented a significantly better battery, then Ind AS 36 confirms the market's worst fears and forces the CFO to record the write-down. The point is, Ind AS 28 merely triggers the requirement to do the rigorous work. It forces management to quantitatively prove that the value is still there.
This journey through the standards has been incredibly illuminating. We started with a simple purchase of 20%, which instantly triggered the concept of significant influence and pushed us out of standard financial instruments and into the realm of Ind AS 28 and the equity method. We watched a massive market crash happen on the exact day of transfer.
We saw the careers panic and try to apply the rules of Ind AS 109 and the phantom Ind AS 39, only to learn that those standards act as strict bouncers, redirecting us back to the associate framework.
We followed the map to paragraph 40, which pointed us to the early warning radar system in 41C. We found the objective evidence, a significant decline in fair value below cost. The alarm rang. But instead of blindly writing down the loss based on a panicked stock ticker, Ind AS 28 handed us off to the specialist, Ind AS 36. That specialist forced the CFO and the auditor into a room to calculate the true fundamental recoverable amount using complex discounted cash flow models. It is a beautifully logical interlocking system once you understand how the pieces communicate with each other.
It ensures that financial statements are grounded in long-term economic reality, protecting companies from irrational market volatility, while simultaneously possessing the teeth to force management to acknowledge true, fundamental, permanent losses when they occur.
We have covered an immense amount of technical ground today. But before we wrap up, I want to leave our listeners with a final provocative thought to mull over. We've talked extensively about the mechanics of the accounting, the models, and the standard numbers. But think about the philosophical implications of the timing in the scenario we discussed today. The massive drop happened precisely on the date of the share transfer.
It raises a chilling question for deal makers, investment bankers, and corporate strategists. If an asset loses 40% of its value, the literal second it becomes officially, legally yours, was the cost you negotiated weeks ago ever truly its fair value to begin with? Or were you simply the last unfortunate participant holding the bag in a fundamentally overinflated market?
It makes you wonder how quickly the brutal reality of an open market can overwrite the reality of a carefully negotiated, legally binding contract. The ink on the paper doesn't protect you from the gravity of the market.
It certainly doesn't. Contracts dictate terms, but markets dictate value. Understanding these accounting mechanisms is how we measure the exact impact of that gravity when it hits.
I want to sincerely thank you, our audience, for dedicating your time to exploring this complex, fascinating labyrinth with us today. Navigating the depths of accounting standards isn't always easy, but it is incredibly empowering when the structural pieces finally fall into place.
If you found value in this deep dive, we have a few specific requests. First, please ensure you follow or subscribe to the Gap Advisors Ind AS Clinic podcasts. The audio series is available on Spotify, Amazon Music, and YouTube, whichever platform you prefer to use. Hit that subscribe button so you are always notified when a new analysis drops.
Secondly, to truly stay ahead of the curve in this profession, I highly urge you to join the Gap Advisors Ind AS Clinic channel on WhatsApp. It is the absolute best way to get immediate, real-time updates on all new videos, new audio deep dives, new newsletters, updates on newly issued standards from the ministry, and alerts when new complex issues are responded to on the repository platform. It's a direct, daily pipeline to expertise.
Finally, technical knowledge multiplies when it is shared. We request you to share this deep dive among your professional contacts, your colleagues, and your audit and finance teams. We especially want to ask you to share this with students who are currently pursuing their CA course. Helping them understand the practical, messy, real-world application of Indian accounting standards is crucial for developing the next generation of resilient finance professionals.
And remember, if you are sitting at your desk dealing with your own tangled accounting webs, you do not have to solve it alone. You can book a one-on-one consultation regarding your specific nuanced issues on Ind AS and IFRS directly with the author of today's source material, C.A. Manish C. Iyer. You can find his profile and book a session directly on topmate.io. Having an expert look at your specific facts and circumstances is an invaluable resource.
Thank you again for joining us in the clinic today.
Until next time, remember our opening scenario. You might have wired the money, you might have signed the term sheets, but until you thoroughly understand the accounting rules governing the aftermath, you don't really know what your foundation is made of. Keep digging deep.